Welcome to the Inside Edge Investors Edge update. It is July 23rd. Here with Kyle. Happy Tuesday to you, sir. How are you?
It is. Always good to be here. How are you?
Good, man. Good. Kyle was out here last week. Had a real good session together. We did a lot of work and we did a lot of fun too. It was opening week at Saratoga and at the racetrack, and we went out and played a little golf. And we even got the intern in. Trevor, say hi.
Hello.
Go the other way.
Other way.
There you go.
Hello.
Trevor's joining us for the summer. He is a freshman going into sophomore year at BU, Boston University. He's in the investment club. Smart kid, working hard. We're lucky to have him. Yes, we do our fair share of ribbing him. Is that the right way to say it, Kyle?
Yeah, it's just light hazing.
Light hazing. These kids these days, they're too sensitive. We can't put them through probably what you and I went through when we were younger. I'm just kidding. No, he's doing a great job. Really, really good. So,
Sure.
well, just thought, let's do another update. Obviously, we're getting more consistent with these, and lots going on in the market that I'm sure you'd like to know about, how we see things from our point of view. And this is going to be a very heavily market focused piece. Kyle, when I was away, no, you just put out your fixed income video, which you guys definitely want to take a look at there. Hopefully you guys all saw that. Opening comments, markets, that fixed income piece, planning, otherwise anything?
Sorry, you cut out for a sec.
Oh, any opening comments, market related from the fixed income piece, planning, anything related?
Yeah. We put out two videos in the last month or so, one with the equity rebalance and one with the fixed income rebalance. So clients, make sure you catch those. This one's more market and economic updates. So just some good information on what we're seeing out there right now.
Yeah,
And
sounds good.
and a busy news cycle, you could say.
Yeah, very busy. Yeah, and don't mind me, I'm gonna be playing with this. This is my IFB I use for TV, and it's broken. I gotta order a new one. Somebody be messing around with this. Forgive me for that. Let's jump in. We did put the disclosures up, so certainly have a look for anything compliance related, all important information. Okay, so four things that we see that are happening that's causing the pullback in the market. And there's a lot that's being made of this. And I think it's coming from four different sources. One, it's kind of like, what are the three branches of government? You got the executive, you got the legislative, and you got the judicial. Well, I'm kind of borrowing on that a little bit. But there's been a rotation that is selling off the growth technology, specifically the semiconductor stocks, and into the unloved sectors like small caps and other sectors that have been left behind. And again, I think there's from four corners: the executive branch with the presidential election, the judicial branch will talk about monetary policy, and then the market technicals. So I'm just going to roll in. Kyle, interrupt me, jump in anytime you want. Please don't wait for me to take a breath, because
I just
please.
real quick, I think our heads are blocking just the bottom left
Oh,
corner of the
yeah.
slides
Thank
here.
you. Thank you. You know what? Let me take those off. Good point. Good. Thank you for that. Layers. Beauty of live television. Good call.
Yep, better.
Okay, perfect. So, we're going to have some details for you. There was a pretty good shift after the Trump assassination attempt. All sorts of fallout in the news cycle on that. And there's other things that are going on. It's a very busy news cycle right now. And in my experience trading, which, a lot of you guys know me for a long time, for the last 20 years, that's what I've done, is focused on the markets. And only the last 3 years have we focused more on, marketing to build a wealth management business. And one of the true things I can take away from 2 decades of trading is you want to be careful about new themes that develop in the summer. Trading desks, hedge funds, and big pensions and mutual funds, and large organizations, they tend to be a little understaffed, and the stories, you get the junior guys on the desk and they're kind of moving things around, and whether that's true or not, whatever. But certainly people do lighten up in the summer, and themes tend to emerge that could be false signals, and I've seen it time and time and time again. So just keep that in mind. There is a lot happening in the news cycle. So presidential election. So the unsuccessful attempt on Trump drastically increased the odds of a victory, and Trump is viewed as America first, closing the border, taking a more protectionist stance. He's not a free market capitalist. He's more of a protectionist, putting the focus on reshoring or onshoring our supply chains and production facilities, specifically away from China and into domestic companies or geographically close regions like Mexico. So, that's not a free market capitalist. That is bringing production and ensuring our supply chains closer to home, which will increase prices, which is probably inflationary. Also, inflationary is keeping the tariffs on China. Tax cuts, that should be a boost, but again, putting more money in circulation out there is inflationary, and looser regulations. So there's been a pretty good shift following the attempt on his life. And since then, we have Biden dropping out of the race, right? So there's been a pretty decent move into domestic small caps. We'll talk about that. On the judicial side, Supreme Court ruled and undid a ruling from Chevron in like their interaction with fisheries back in the late 80s or 90s. And basically what it did was it took the interpretation, the ability for federal agencies to interpret ambiguous statutes, and the rulings have to defer up to the federal agencies. And they took that power away and put it in the hands of judges and courts to interpret those ambiguous statutes. And the reachings are it's pretty widespread to various agencies, including the SEC. So that kind of goes along with this idea of deregulation and a little less power in the hands of the federal government. So that's interesting, and specifically with the SEC. We can talk more about that. Monetary policy, we have recent inflationary events, CPI and PCE, personal consumption expenditure, which are inflation reports that have been on the decline. And we now have about between 95 and 98% chance of our first interest rate cut in September. And it's significant because we essentially have been on an increasing interest rate environment since 2017 and 18, when the Fed first really started raising rates, and then COVID came and they dropped rates. And, but we've been on a interest rate increase cycle for several years now. So we have clarity as to when our first rate cut may be, barring something quite significant between now and September. So that's another reason that we're seeing a move into small caps, and we'll talk about what that means. And the market technicals, profit taking from the large cap growth trade, the semiconductors and large cap technology that have come very far ahead of Q2 earnings season, which we are now in. Tonight, we have Tesla and Google reporting, and these are the first real two significant heavyweights that reported earnings on the growth side. So it's underway. We also have seasonality. We'll talk about that. We're coming to a weak stock market period now and through September. Usually it's weaker stock market, higher volatility. And then finally, as I mentioned, we're in summer doldrums. Unusual market movements do develop in the summer months. So, for these four different reasons, we're seeing a move out of growth stocks and into small caps and unloved areas of the market. And that's essentially what we're going to talk about. Kyle, anything there?
No, all good.
Okay. So this is real clear politics, the betting average. This isn't the odds. This is people literally betting on the outcome of the election, which has some degree of usefulness when it comes to predicting outcomes. So this spike right here in red was the July 11th assassination attempt. Trump went from about 56 to 66%, and that was while Biden was still in the race. And as the red line went up, Biden in blue dropped, bounced back a little bit, and then as we got more clarity that he was not going to be the candidate for re-election, he dropped away, and Kamala Harris moved up. So this is captured yesterday. So Harris is at 30.5% chance, where Trump is 59.5. So it's essentially 2-1 Trump to Harris right now. Jumping around a little bit, the U.S. stock market, I think, is still very healthy. And the point that I think we'd like to make here in this presentation is I see the sell-off in growth stocks. We have a healthy allocation of NVIDIA in our growth portfolio, which is TAG, and we have an allocation in our dividend portfolio, which is SIG, because NVIDIA actually pays a dividend. And in our recent rebalance on June 24th, we increased the allocation in semiconductors. And yeah, semis and growth have sold off. But again, for the reasons that I think I'll show to you, and we're already seeing evidence that the selling may be over and they're starting to come back into these names. Even aside from this little 5% pullback that we've seen in the summer, where's the U.S. stock market relative to the rest of the world? And I was going over this with Trevor, the intern, and showing him how a lot of money managers would say, well, you got to have international exposure. You got to have emerging markets exposure because it's part of a well-diversified portfolio. And Colin and I have talked about this a lot. So if you look at the S&P return over the last 10 years, the SPY is up 177%. And the biggest ETF you can look at, the Vanguard FTSE All World ex-US, so all developed and emerging stock markets in the world, not including the US, in that same 10-year period is up 13%. So yeah, it's great that a money manager wants to be diversified and has you overseas, but with whatever, 5, 10, 15, 20% of your portfolio underperforming the S&P by 100 and what is that, 64% over 10 years, that's a problem. That's a problem in my book. So,
Yeah.
Go ahead if you want.
Yeah, no, go ahead. I think it's just it just shows how you can over diversify, and there's definitely a sense of diversifying just to diversify. If there's little value, if you look at the macro picture and see, if you're looking at international stocks, everything that's been happening in Europe and Asia, like there's been way too much volatility and risk and not enough going for it for that investment decision. It doesn't mean there won't be some sort of change, but I think you have to look at it the same way you look at semis, and that is, what's changed in the big picture. Like we think there's still a ton of value in semis with it going down. We look at international with the same kind of scrutiny. How is it doing now? What would need to change to give us that optimism for it?
Yep, exactly right. And there'd have to be a real structural shift in overseas markets, emerging or developed, for us to significantly, to have an allocation over there. I mean, those of you who follow closely on the trading analysis side, the research business, the Nikkei has been doing very well, has been hitting all-time highs. But you look at the Chinese market, no thanks. You look at the South Korean market, no thanks. It's pretty few and far between. So, yeah. Sorry, I'm playing with this earpiece. This thing is annoying. I'm going to throw this away. But the two graphs below, these are some of the specific tools that we use on the research and behind the scenes on the wealth management side to show the relative rotation of a market to some underlying benchmark, which here is the S&P. And the fact that generally what happens is when a market rotates into favor, it's going to move in a clockwise direction. Well, the all world ex-US is moving in the wrong direction. It's weak and it's in a heading that says it's getting weaker, right? And this is the monthly rotation. Each dot represents 1 month of trading, and over here is the weekly. This is a shorter term, is 1 week. So you have monthly and weekly heading in a direction that suggests the underperformance of all world ex-US to the US should continue. So, the last piece that we did showing the $54 trillion market capitalization of the US compared to China in second place at 10 trillion. Like that's because American companies are innovating and supplying services and technologies to the rest of the world that they need. And that gap is likely going to continue to grow. So, again, if you have a money manager saying, wow, you need to have international exposure. Well, okay, diversification sounds like a wonderful story on paper, but when you look at what's actually happening right now, it's costing you money. And that is not always going to be the case. There's certainly going to be times in periods where we need to have overseas exposure, but I don't see it right now. And further underlining that point, this is the BRICS. So BRICS is a term that was coined by a guy, Jim O'Neill, who worked for Goldman Sachs. But he was like the chief economist back during the global financial crisis. And BRICS is a short for BRIC, which is Brazil, Russia, India, and China. And long story short, Jim O'Neill, who's a world-renowned economist at Goldman Sachs, showed that there was a inverse relationship of commodities and stocks that was well established. The more expensive input costs go up with commodities, the more the higher cost of production is for companies. So generally there's an inverse relationship between input costs and stocks. Well, with the emerging markets coming online, BRICS, there was now a positive correlation where these emerging markets coming online demanded high degrees of commodities to build out and join the global trade. So it created a direct correlation of commodities and stocks. So just a little history lesson for you there. But these countries are certainly online now. We know Russia and China are having their own issues. But it just goes to show that these emerging markets, specifically the BRICS, and you show the performance of the S&P versus BRICS 50. This is going back to roughly 2010. And the same thing on the rotation graphs. The BRICS relative to the S&P 500 has taken a turn for the worst and has tried to rotate in over here on the weekly, but got rejected for moving in the right half, which over here exists outperformance to the benchmark, which again is the S&P 500. Tried to move in over the last 6 to 8 weeks, but got rejected. So again, even the emerging markets still look like they're going to be underperforming the S&P for some time to come. All right. Now, bringing it back to the U.S., there has been a big move into the small caps. And small caps are generally companies that are $2 billion market capitalization or less. And that index is the Russell 2000. And I was just going through, I was showing Trevor the earnings of all the S&P 2000 companies, the Russell 2000 small cap companies, and just looking at the internals. And we'll get to that in a second. But if you look at the Russell 2000 small cap index compared to the S&P 500, this is a percent return from the beginning of 2023 to now, so roughly a year and a half. The S&P is up 44.2%, where the Russell 2000 is up 25. On the daily year to date, S&P up 16.2 and the small caps up 8.8. And you're going to notice that the Russell was just going sideways for a long period of time. Then all of a sudden we got a big, massive push up. And that was July 11th. That was the assassination attempt. That was them using Ronald Reagan's assassination attempt in the red wave, with I think the exception of Minnesota or Michigan, if I'm trying to remember. It was being extrapolated or pulled forward into now. And for the reasons I mentioned in the opening slide, Trump being more America first, deglobalization, divesting from China, bringing supply chains closer within our borders or near our borders, namely Mexico and South American countries. So that's the reason that we saw small caps go up. Now, I don't want to get too far down this line, but those of you who have some trading experience will be able to follow here. But basically, when you see a very sharp move up like this so quickly, especially in a huge broad index like the Russell 2000, that's not normally new, fresh investment money coming in. What that is hedge funds and big, huge traders who are actively trading massive positions, they're covering shorts. And basically what the hedge fund trade was over the last however year or two was to be long the NASDAQ, long the growth stocks, but their margin department, or whoever was their risk compliance or risk department, made them offset some risk by being short the Russell. So short the small caps, which are underperforming, and long the growing, money printing growth tech stocks. So the minute we had the July 11th events, plus we had evidence that we're going to get the first rate cut, those shorts came into cover because those small cap companies are susceptible to higher borrowing costs because they have to go to their local banks. Local banks borrowing costs are set by, the prevailing interest rates around the globe, which are going to be, very influenced by the Fed. So as we saw interest rates go up, borrowing costs for small businesses got very high, and then the leveraged, financially unsound companies underperformed, and that's why so many companies, the Russell 2000, underperform. That's why the Russell 2000 is underperforming the S&P and the NASDAQ. Well, the point of this long story is, as soon as we got visibility as to that rates are no longer going to go up, one of the fundamental reasons for underperformance of financially unsound smaller companies that are susceptible to higher borrowing costs, once the rates start to go down and tick down even 0.25% or 0.5, that's enough for the big traders to say, okay, enough, I'm going to cover my shorts. The way you cover shorts is you have to buy back, and that creates panic buying. So on top of that, it happens in the middle of July, the middle of summer. That smells short covering. So there's a lot of people saying there's going to be a big rotation out of semiconductors, out of the growth trade that's worked for so long, and into the small caps because Trump may win the election and so on and so forth. I don't see it. I don't believe it. I've seen this before. Yeah, there's short covering coming in, but the underperformance in small caps to the more established trend of large cap growth is there's way too much of a divide to say, two events that just happened is going to unwind the whole thing. And there's slides that we have after this to show you. So I hope that makes sense, and I hope that's useful. Kyle, is there anything you want to add on that?
No, that's good.
All right, move on from that, right?
Yeah.
Another slide on this, which is interesting. This slide only goes to show that I think the idea of short covering, which again, shorts are people who are trying to bet that the market is moving down and trying to profit from it. And the way they exit that is to buy back the short. So it's not like there's new money coming in. It's exiting a position that will benefit on a decline in price. And this is an ETF that I like to track, which is the CAF. So this is the top 100 small cap companies, but the highest level of free cash flow. These are fundamentally sound, but still small cap companies. And the point that I'm showing you here is the IWM has been outperforming just recently the CAF, the top 100 free cash flow companies. And I was just showing Trevor this work that he did, the spreadsheet of the 1,964 companies that are reporting earnings within the IWM. 849 of them have negative 12-month trailing earnings. They're not making money over the last 12 months. So again, just because we have one or two interest rate cuts does not mean there's new money coming in on a long-term investable trend on small cap outperformance relative to even the fundamentally sound small caps. It really smells like short-term short covering for me. And that's the whole point of that. So again, when you get unprofitable companies outperforming profitable companies in a midsummer geopolitically driven environment, for me, that raises red flags.
Yeah. And I think rates would have to go down more to complete that rotation
100%.
because they're still well above 4, and that's great to refinance, but it's not going to make a huge difference on these 850 companies balance sheet that are surviving on financing and refinancing.
It's 100% correct. And I used to trade for a hedge fund during GFC, the global financial crisis, and one of the key lessons that I learned is we were trading. I was an FX hedge fund, so we were trading foreign currencies, and the key driver of FX flows, dollars to euro to yen to Swiss to Aussie, is the level of interest rates. And it's not only, if one country is paying 5 and another country is paying 2, What happens is people borrow in the country at 2%, invest overseas at 5%, make net 3. And, that's great, but markets will trade based on the idea that the gap between those two is going to continue to widen. Once traders have visibility as to when that gap is no longer going to widen and maybe start to narrow, it's the rate of change that will cause that idea to be unwound. So it's, once we start to get visibility as the rates are no longer going up, Powell said rates, the next move is very likely down. That's enough for people who have expressed a market view on that to unwind that, right? And to exactly what Kyle just said, 2 rate cuts is not going to all of a sudden make those 850 companies profitable. It's enough for those who are short Russell, the index, to say, okay, enough's enough. I'm going to take it off and create that short covering. So probably more than you ever wanted to know on that, but that's what's happening right now. And I'm very confident that that's what's happening. Last thing I'll say, I was on a Twitter broadcast with like 700 people, and there was 4 or 5, prominent investment industry people, and like 5 of them were like, "Oh yeah, this is the time to buy Russell, and this is the time to buy small caps." I'm like, guys, like I think you're missing the big picture here, and I don't know. So we'll see. So anyway, so here's CPI and PCE, and these are consumer price index and the personal consumption expenditure, the two, headline inflation readings. This is going back into the 70s, 80s, 90s, 2000. Here's the post-pandemic spike. Inflation ripped and has come off, I would say, just as sharply. Now, last reading at CPI was 2.97% headline year over year, and the Fed's preferred inflation gauge, PCE, was 2.56. The Fed stated inflation target's 2%. Powell was at the New York Economic Club 2-3 weeks ago, and he was saying you can't wait for inflation to get to 2% to start cutting rates, because it's not like you can just turn it on a dime. So we're on the downward decline. We have PCE reading coming up Friday, and today is Tuesday. So that's going to be a big one. But you can certainly see the downward trajectory in rates. Now, a big one, a contributor to inflation, the persistent inflation, there's 2 things. There's housing prices, and believe it or not, it's insurance, and auto insurance, for some reason, is two of the biggest. Food is up there as well, but housing is a big one. We're going to talk about that in a little bit. So Fed Fund futures, this is the probabilities over the next 12 months. So right now, the current Fed Fund futures rate's 5.25, 5.5. At the July meeting, there is a 97% chance we're going to stay where we are. And then as we go out to the September meeting, there's a 95% chance that we're going to lower the range by 25 basis points, which is 0.25%. And then to November 7th, there is a 49.29% chance of going another 25 basis points. There's also a 50.71% chance that we stay at our new 5.25 range. And you can see and follow it on down. So as of now, the market's pricing 1, 2, 3, 4, 5 rate cuts out until this time next year. Now, we've seen this before at the beginning of this year and the end of last year. They were pricing 6, 7 cuts. Then we went down to no cuts. Now we're up to 2 cuts, and now they're trying to put 5, 6 cuts back on the table. There's really not a lot of visibility going out more than 1 or 2 meetings, so I wouldn't read too much into this. It's really just the next 1 or 2.
Yeah, I agree. This is their kind of their ideal scenario, and I mean how the economy, how growth, GDP comes in, is going to play a huge part, and unemployment and all that, so they can change their mind very quick. None of this is set in any sort of stone.
Yeah, and these guys literally trade just like stocks. I mean, you can watch them tick a minute after a data report comes out. You'll see the probabilities change. Literally, it's a futures market that trades. Yep, good point. So what we're looking at here is the 2-year U.S. yield, and this is one of the key determining drivers, I would say, of the Fed Fund futures, which is this guy. When the Fed gets together 8 times a year and sets their policy rate, it's really short-term interest rates, and the 2-year probably has the most influence over it. So the 2-year yield is here in red, and right now we're at 4.46. Now, if you remember, I said that the current target range in Fed funds is 5.25 to 5.5. The 2-year yield is at 4.46. So the 2-year yield is already pricing in roughly 50 to 75 basis points of cut. On top of that, the point of this slide is you look at the 2-year expected inflation. This is published by the St. Louis Fed, a central bank, a member bank. And you can see inflation expectations 2 years out spiked here in 21, made a lower high, and they're saying 2 years out we're looking for 2.5% inflation, where you can see the 2-year yield made a couple higher highs. So there's a gap here between 2-year expected inflation and 2-year yields, which you can see they're pretty decently correlated. And again, the 2-year yield is 50 basis points below current Fed funds. So you have expected inflation lower than 2-year yields, 2 years lower than Fed funds. So everything's pointing to rate cuts, which the point is rate cuts should be good for the growth trade, which again is technology, communications, and consumer discretionary. All right, so this is the 2-year yield that we just talked about in blue over the Fed funds rate. And as I just mentioned, Fed funds is stuck up here about 5 to 5.25. See the flat part there? So that's Fed funds over the 2-year yield. And you can see these guys are even more correlated. And what I did up here is I included a spread between the two. So the distance between the 2-year yield and Fed funds right now is about 0.91 basis points, or 0.91%. And you will see that going back into the 80s, 90s, and 2000, that's about as large as it gets. I mean, we would get up to 1.2, 1.5 area in the 80s, 90s, and 2000. Going into 18 and 19, we got up to this level, and you could say this is quite elevated. Again, largest spread in 15 years between Fed's policy rate and 2-year yields, which means the Fed's policy rate is too expensive right now, which is why there's so much price. There's cuts being priced in. Okay, this is sort of anecdotal. This one serves two purposes. One, it serves as a little bit of a warning sign, and number two, it helps us put the argument that we're in the stagflationary 70s and 80s to rest as not true. So this is the concept of real cost of capital. So it's the Fed funds, which we've been talking about the last two slides, and you take away the core inflation rate. So what the borrowing cost is minus what the inflation rate is. Again, if you're servicing a 5% loan, but inflation's running at 3%, your cost to carry that loan and service that debt is net real 2%, right? So, if you look at this, the cost of capital back in the 70s and 80s spiked up to 6, 7, 8. You look at the green line, 8, 9%. Cost of capital here post-pandemic was negative. You're actually paid to make loans, but we've since gone positive, and right now our real cost of capital is 2%. And again, that's a 6% borrowing cost factored in and a 3% inflation rate. That's a 3% real cost of capital. So, all right, yeah, cost of capital is low, and that still does stimulate borrowing by companies and corporates to invest in their future operations, buybacks, whatever it may be. The warning sign is from a technical basis. Those of you who've looked at technical charts, you like to see when you can connect the peaks like that, a trend line to hold resistance and back away. Yeah, it's broken through resistance, so I'm watching that. But if the Fed funds starts cutting and CPI remains as is, if the Fed starts cutting, this guy is going to drop down to 1.75, 1.5, 1.0. It should come back and return to the line if inflation remains as is, but the Fed starts lowering rates. And you can see the impact on the stock market as real cost of capital is dropping. You would say there's a pretty solid positive correlation to the S&P. Picking it up a little quicker here as it pertains to housing, longer term rates, the 10-year yield is one of the key driving factors of the 30-year fixed mortgage. And as I mentioned, one of the biggest drivers of inflation in here is housing prices. And if mortgage rates stay high, people are not going to come out of those rentals or go buy that house they want or upgrade the house they want. So what's happening is if we do get a drop in yields, in 10-year yields, there is a very strong correlation with 30-year fixed mortgage. If 10-year yields drop, mortgage rates drop. Mortgage rates drops, more people come into the housing market. You look at home builders, we own a couple home builders. Those things are ripping higher since the middle of July. Because again, we have clarity as to where rates are going. So people are coming in and starting to build those houses, counting on the ability to refinance later. And that's just another vote that rates are going to come down. So here's the 30-year fixed mortgage. It's 6.77. There's the 15-year 605, et cetera, et cetera. Same concept, 30-year fixed mortgage minus the 10-year U.S. Treasury yield. Clearly, they're correlated, but there's always a premium of 30-year mortgage compared to the 10-year. And we got up to a resistance level of about 3% difference between 30-year fixed mortgage and 10-year. You can see it. We're at 6.89 in the 30-year fixed mortgage to 4.2 in the 10-year. That's going to be a spread of what, 2.69 or whatever. And there it is, 2.69. So resistance on this spread has held, but if you were to look at this chart and use technicals, you would say we should begin to move towards the lower end. The average is probably 1.5, 1.75, maybe 2. We're still too expensive in mortgage rates. And I would expect that to come down and hopefully move to the lower end of the support zone at about 1.5. And again, that's going to bring more buildings, more housing starts into the equation, which is going to ease inflation because supply shortage comes off. And that's one of the key drivers of inflation. And the market's already moving on the idea that all this is happening because rates are coming down and et cetera, et cetera. Here's the home builder ETF overlaid on the 10-year U.S. yield. Not a great correlation, but you can see every peak in the home builder ETF is generally accompanied by a drop in yields. So peak in home builders, drop in yields. A drop in home builders is a move up in yields. They're both basically trending in the upside, but again, if you look at the peaks, they're generally opposite of each other. And if the 10-year yield is truly rolling over, heading 4.2, 4, 3.8, 3.9, I'd expect to see the home builder ETF continue to go up. These home builders are crazy. Literally, they're crashing higher. Over the last 2 weeks, they're up like 20 or 30%. It's insane. Yeah, we do have some home building ETFs, not enough, or we do have some home builders in our portfolio, not enough, but it's pretty amazing to watch. So there is certainly building coming back. You have supply chains opening up, people are going back to work, and you have yields, interest rates dropping with confirmation that the Fed is no longer raising and going to start cutting. Whether we get 5 or 6, we'll see. Anything or keep rolling, Kyle?
Yeah, I mean, I just echo what you're saying on home builders. It was a surprise, and I think there's also some people, you mentioned the high points, but people probably accepting higher rates. They've been waiting to move, and they just said, like you said, like we're going to go ahead and do it, and then hope rates come down and we can refinance. But I know people that have been waiting to move for a couple of years, waiting for rates to come down and shave a lot of money off of a mortgage payment. So I think there's been some accepting on the higher rates thing, and if you go back to what the Fed might do in the next year, what they're projecting, it doesn't look like rates are going to go back down to zero anytime soon.
No.
So it's like, what are you waiting for? Another 1% drop in a year may not make, people may go ahead and pull the trigger anyways, and probably are.
Yep, exactly. And then just to spot check some of the names that we hold in SIG, like here's Pulte, PHM. I mean, here's July 11th right here. So the stock was at 106. Now we're at 125. We hold Pulte. We hold or KB Home, KBH.
Right.
KBH. This guy. I mean, we closed July 11th at 66, and now it's at 82. We don't hold DR Horton, but this guy's been just a ripper. 137 to 177. I mean, literally they're crashing higher. It's pretty funny. All right, so we'll pick it up here a little bit. I think we've beaten interest rates to death, but you know what? That's been our reality since 22, in 21. Like post-pandemic, rate spiking, like interest rates have been the key driver of equity markets. It's crazy. In my short 20 years doing this, I can never, even during the GFC, I can't remember such an interest rate driven market. Like what the Fed does and the short-term rates versus the long-term rates and yield curve, like that's what's required to be an equity investor right now.
Absolutely. And they
Yep.
keep adding tools to their disposal too, like all this open market operations and everything too. Like the Fed is really driving a lot these days and changing the economics textbooks and everything along with it.
Yeah, exactly right. So here's the 10-2 curve, and this is the so-called yield curve inversion. And this is a 20-minute conversation in and of itself. And you know we've talked about it a lot before. I'm not going to go into it too much, but basically we are coming out of inversion, and the idea is when you go into reversion inversion, which is the red, which means shorter term rates are higher than longer term rates. 2-year yields are higher than 10-year yields. That creates a yield curve inversion situation, which the last 2 times has led to recession, which is in gray, and the stock market selling off. So yield curve inversion, recession, stock market selling off. Yield curve inversion comes out, recession, stock market sell off. Yeah, but different. That was housing crisis, or this was the tech bubble coming off and the housing crisis. There's other numerous examples prior to 1999 where yield curve comes out of inversion. We do have a recession, but the stock market goes higher. And we talked about that enough. This is the nominal 10-2 spread. We are 26 basis points inverted, coming off of worse levels. And then here's the real yield curve. Again, the concept of, you know, if you have 5% in interest rates at 3% prevailing inflation, your real rate is 2%. So if you look at inflation adjusted 10-year minus 2-year, this guy is less inverted than the nominal curve. And again, there's plenty of precedents even prior to 1982 in this chart to show that coming out of inversion is a good thing for the S&P 500. Okay, so we'll continue to monitor that. This is a quick one on gold. Again, the concept of real yields, and I know some of our investors ask us about gold. This is gold and orange, but flipped upside down on its head. So you could see gold going. I remember trading gold when I was a professional trader in San Diego in 2000. Gold was at 2001. Gold was like $220 an ounce. So 400, 1,000, 1,500, 2,000. So this is gold upside down. And it's generally correlated to real yields, 10-year real yields. So your 10-year prevailing interest rate, and then you subtract the expected inflation published by the central banks 10 years out, and that's the real yield. If what you can make on a real yield is decreasing, that's the time that you want to see the gold market go up, right? Because if the amount that you can make on a real investment on net real terms is decreasing, that's the environment in which gold goes up. Well, it's divorced from that relationship right now. Gold has been rallying as real yields have been going up. However, the real yield, which the 10-year yield right now is at about 4.2, expected inflation is about like 2.5. So your real yield is 2.05. You can see we've kind of put a triple top in here. Is the gold market moving higher foretelling a drop in real 10-year yields? That might be the case. Maybe the real yield catches down to this chart, which confirms gold going up. Is gold a good investment? Yeah, but the same conditions that drive gold market higher, the same conditions that drive stock market higher. And there's better potential returns in the stock market than there is in long gold. Gold is not a hedge against inflation. Gold is not a hedge against geopolitical uncertainty. Gold is a confirming risk-on market to the growth stocks, to technology, to consumer discretionary and comms. And it's a crazy concept that, again, I don't think a lot of people really understand, but that's okay. So you can have gold, but you want the stock market to go up, because when you get the dynamics that drive gold down, which is higher interest rates, higher US dollar, those are days the stock market's down. Those are the same day gold's down. So it's pretty crazy how it works. It's not always going to be like that, but that's the way it is right now. Some of the little bit more in-depth technicals that we do day to day to kind of gauge where we are in the market. Here's the S&P on the weekly, and we've broken above the 2022 highs. This little sell-off right here is the summer swoon right here that everybody's concerned about, that I'm trying to calm people and say, look, let's keep this in perspective. That's the whole point of this presentation here. Now, on the technical model we look at, there is some overhead resistance that we're going to have to contend with. In the S&P 500, as we're trading roughly 55, right now we're about 55.80. There is a zone of resistance at 56.80 up to 58.80. So call it 5,700 to 5,900 in the S&P. We may have to contend with this zone as overhead resistance. At some point, we're going to need a correction that's labeled with green 4. That may be a little bit more significant, than even what we saw here in 23. But ultimately, this gives way to a new move up into a higher zone that I have between 7,500 and 8,000 based on the model that we follow. So we will have this correction to contend with. Is it this year or is it next year? I think it's next year. I think we're going to have to deal with a pretty decent correction that we will do our absolute best to guard against and minimize volatility. I don't think it's going to be as large as 2022. I don't think so. I think it's going to be similar to what we saw here in 23. So it might be a 10, 15, 18%, and then we should regain our footing. And the model says then we move up to significantly higher prices. So we're prepared, and I'm certainly, on guard for something deeper, but I don't think this is the start of it. And this is just the daily chart. Each one of these bars is 1 day of trading, where the prior chart was 1 week of trading. So just a simple uptrend from Q4 of 2023. This is the S&P. This is the sell-off that I think so many people are concerned about. And this is why I love charts. It just puts the move in context to see where we've been, where we've come from, the magnitude of the move. And you're like, okay, deep breath. Let's not panic, and let's actually potentially look at this as a buying opportunity. So yeah, we increased the aggressiveness of the growth portfolio. I knew that this was a possibility. I didn't know we'd have an assassination attempt and so on and so forth, and such a swing in the polls and Biden to drop out, but it really hasn't changed much. I don't regret getting more aggressive, Kyle, in the portfolios. And I'm absolutely fine with where we are.
Yeah.
Anything there,
And just
man?
so technically, just technically speaking, this diagonal line, for anyone that doesn't follow technicals a lot, if we were to see the S&P cross significantly onto the other side of that diagonal line, that where you see the 56.19, that would be like breaking through that channel, or not channel, but kind of trend line. And then we would reassess and see how things look, without that line being kind of valid anymore.
Exactly. I mean, I can even, putting myself on the spot here, I can even pull that up really quick. This is the CBC. Let me just I just want to update that, even since we captured this like a couple days ago. Red count.
And it's just a frame of reference for us, seeing, where those bounce back points are. That gives us the decision zone on when we might see the pattern break.
Exactly. And
So it didn't even touch the line, did it?
It didn't even get to it.
Yeah.
Yeah. And these are some of the ratio measurements we look at. Those are expected support zone, and we've held. Now we need to get continuation back up, but we're coming to some pretty significant earnings here. So yeah, it just keeps everything in context. All good there. So earnings. This was as of this Friday. Today is now Tuesday. 14% of the companies the S&P have reported. Of these companies, 80% have beat analyst estimates, which is above the 5-year average of 77% and above the 10-year average of 74%. And as John Butters, who publishes a really nice research, if we really want to get into it, he'll then go on to say that the average by which these companies are beating is 5.5%, below the 5-year average 8.6, and below the 10-year average of 6.8. So 80% of companies are beating analyst expectations, but they're not beating by enough. Okay, but we're only 14% of the way through reporting season as of last Friday. And what we're looking at here is in blue is the S&P 500 price on the left scale, and in the dark blue, this is EPS, earnings per share. So what they do is over 4 quarters, they sum up all the earnings of the S&P 500 companies. Let's say Apple makes $4 a share, Nvidia makes $2 a share, another company makes 30 cents a share. They add it all up, and if you have, let's say, 4 quarters, each quarter the S&P companies are making $60 a quarter. That's $240 aggregate in earnings for the year. And earnings are what drives the stock market. You can see the expectations for earnings going up. I was just listening to Tom Lee again. I remember back here on the way post-COVID, people like, we're never going to get to $220 annual earnings in the S&P. Couple years later, we're at 260. He was saying, I think it was back in the GFC 2008, and I was trading the hedge fund and the FX side. I wasn't as focused on the equity markets then, but he's like, people are saying, and I like Tom Lee. I know him. He's a prominent analyst. He's on CNBC all the time. Met him several times. And he was saying back in 2008 that prominent analysts are saying we're never going to get back to $60 or $80 of earnings per share for the year for the S&P. It'll be a decade before we get there. $60, $70, $80 of earnings. We're now at 260. So he's like the growth potential because of the shortage of workers and that last slide that we showed in terms of the market capitalization gap of our companies relative to the rest of the world in the problems they're solving, specifically the global labor shortage, and the ability for companies to buy technology to replace workers. He's like the earnings potential is massive here, and I very much believe that. Anything there?
Yeah, I mean, I remember like the S&P just testing 3,000 for probably a period of 6 months or so. It would have been like 2019, and I think I just agree. I think tech has taken the lid off of the potential for companies not just to like do their business better, but save money and increase efficiency. All that shows up on the balance sheet the same. So it's just a big opportunity. It's a new phase of growth, and I think it explains a lot of what we've seen.
Yeah, exactly. And the whole the foundation, the bedrock of this firm is we are not mandated long only from some higher management board compliance department. We're active management where when we do see bumps in the road, significant volatility pockets, we can get conservative, we can protect, and we can put hedges in. We're not mandated long. In fact, volatile down markets, I think, gives our company the ability to stand out from the others who are just basically asleep at the wheel and just long only, not focusing on it except for gathering assets. I look forward to that, but I don't think that's this time. I think it's time to have foot on the gas pedal.
Yeah. You've got investors markets and traders markets, right? And the investor wants to see what we saw for most of the year, the slow creep up, and then the trader can provide some value when things get choppy and make changes.
Yep, absolutely. So Yeah, so these are the EPS expectations for the year. So calendar year 2024, we're between expected $240, $250 a share for 2024, which you now have 5 months to go. And then for next year, analysts are up to 278. I mean, you look at the growth in earnings from 2020, like holy bananas, that's crazy. That's huge earnings. And this is the
That's
S&P
double.
500. It's a double,
Yeah, just gonna
140
double.
yeah, 140 to 278, almost a double. That's insane. And then okay, so this is broken down by quarter. So we're now we're reporting on Q2 of 24, $59 a share collectively. Q3 of 24, analysts are looking for 62, 64, 64 on up. So those are the expectations for earnings. Now, just because they're analyst expectations doesn't mean that they're going to come true. You know, you never know what's around the corner, but institutional flow that does drive stock prices higher does act on that, and it's stuff that we want to be very much aware of. As I mentioned, seasonality, we are coming into a negative period. So this is the NASDAQ. Each month's performance broken down. Right now, we're in July. We're up 3.3%, which traditionally July is a good month for the NASDAQ. Probably the third or fourth strongest month of the year. August is weak. September is very weak. So we're coming into a seasonally weak period. S&P, same thing. When I captured this last week, we're up 3.1%. We're going to be up more now. But July is a good month, probably third or fourth strongest month. August is flat. September is not good. The Dow. This is actually the strongest month of the year for the Dow. And then same deal with September. And then same thing, volatility. Volatility is generally inverse of the stock market. We're coming into 3 volatile months, July, August, and September. So we're very much aware of that. You know, with the VIX up, that generally means stock market's down. And this is the average from 1990 to 2024. So you're talking 34 years of average. So we're going to be watching, you know, and if we do get volatile and the seasonals start to take effect, okay, we'll take some protective measures. I'm not going to get crazy and dump a bunch of stock, but we'll take some protective measures, raise some cash, and maybe smooth things out a little bit if seasonality does step in. So we're going to be aware of it. We're going to be aware of it, okay? Bitcoin, I think, is more of an isolated story. Bitcoin is up at the highs, and we are right on the cusp of breaking all-time highs in Bitcoin. If you have allocation to Tactical Alpha Growth, you have about a 2% allocation to IBIT, which is the Bitcoin ETF. Trump is viewed as positive for crypto. He does not want to have a centralized digital token, a central bank token where the government can track all citizens' transactions. He's against that. He's speaking at the Bitcoin conference in Nashville this week that starts tomorrow. He's sided with libertarians on that are very much for, you know, a private, you know, monetary system store of value that the government isn't able to infiltrate. So crypto is bid ahead of a expected Trump victory, and JD Vance is also pro crypto. So if it can break through 72, 73K, I don't see why it's not going to go to 100,000. I was on CNBC last week at some point talking to Brian Sullivan about it, and it's unfortunate. I know Brian very well, and I was on the second to last show. Unfortunately, the show last call got canceled after a couple years. So, oh well. But Brian they'll find something else for him to do at CNBC. They've been trying to fit that 7 o'clock news slot for a while. All right, I know we're going a long time, but this is important on NVIDIA. This interview with Rick Reeder, I hope that's Ryder or Reeder. He's the head of global allocation and fixed income at BlackRock. This was a really good interview. And I think it really sums up, you know, the way we see the markets, and I'm paraphrasing / quoting him here. Here's the link if you want to try to grab it from the PDF to see it. But he's basically saying Technicals drive the market more than most realize. There's not enough stocks for sale that you get real concentration, particularly in areas where we get real earnings growth, and they buy back a huge amount of stock. And we're going to talk about what that means buyback, specifically the Mag 7, the large cap magnificent 7. If you create those kind of earnings, which again, Mag 7, the earnings that are being created in large cap growth is astounding. With 18 to 19% ROE, return on equity, that builds book value, plus the equity buyback, that's a darn good technical still in place. Rate paradigm still in place, low volatility, low equity volatility. Those of you who trade options, is a good time to have options. So what I want to show you, going back to my belief that the growth trade with generative AI and this rewiring, retooling, repurposing of the internet to drive efficiencies and help industries across the economy scale, NVIDIA is at the forefront of it, and they have a 2-3 year advantage on everybody. You look at the EPS growth that NVIDIA has both realized from 17, 25, 44 cents a share for the year, 33 last year, all of a sudden this year, $1.30. Next year, 274, 367, 434. You look at the growth that NVIDIA is putting out there, combined with the ROE, the return on equity, 18, 19, 20% is a good ROE. NVIDIA's out there putting 20s and 30s out there. This is quarterly. Here's the annual ROE, 32, 46, 49, 26, 29, 44, 17, 91, 115. Like crazy return on equity. Plus you look at the margins this company's running. They're running 60% margins, gross margin, looking to expand that. So the point here is the free cash flow that NVIDIA is going to generate, if these forecasts even come close to fruition, is they're going to have so much free cash available on the balance sheet. The Justice Department is already keeping an eye on them because they're becoming so large, but it's not a monopoly. They've just outperformed other competitors. The estimate is they're going to have 270 in cash in the balance sheet, and they can't go buy other people. They can't do acquisitions because then the Justice Department, then the monopoly question is going to come into question. The only logical thing is to do more share buybacks, and that's going to drive the stock price higher. So you look at the buybacks that NVIDIA has done in orange, overlaid on the price of NVIDIA in blue. If they're going to generate and grow earnings like that with those kind of margins and that ROE, I mean, here's another interview on CNBC that you should grab and take a look at. There's a lot of cash that NVIDIA is going to have to do something with that most likely gets put into shareholder buybacks. And if you look at the EPS, which I don't think I included it here, did I? No. You look at the earnings growth that, oh, I did, of course, that NVIDIA is putting out there. Like, the stock, if you take $2.74 and divide it in the current price of NVIDIA, 120, you're going to get like 45 times forward earnings. The S&P right now is 21, NASDAQ's 28. Like, NVIDIA growing at this size and at this clip at 45 times next year's expected earnings is not expensive. The point is, could this stock go to 200, 300, 400, 500? Yeah, it could. It absolutely could. And I think it does. So, you don't get hit by the train you see coming. And here's a perfect example. But, I think there's bigger forces at work. CrowdStrike, let's talk about this. So this one got hit. This one shut down the internet, and this one hurt. We have CrowdStrike. Trevor put this together. Thanks, buddy. Good job on the slide. On the left one here. Let's see how the intern did, Kyle. The IT outage caused by the software update CrowdStrike released had wide-reaching effects and rendered servers across the globe useless for hours. The outage sent stock tumbling, reaching lows of 260 after sitting at 400 days before the outage. We're watching very closely for signs to reduce our position. Yes, well done, sir. So yeah, we're watching the stock. It's come off quite sharply. There's very likely going to be lawsuits on this. We got to see how it behaves. came in at a very expensive valuation. It was trading about at a 90 PE. Now with the sell-off, we're at about 60, 65 times next year's earnings. It's still expensive, but this was the darling of internet security. The technical models I look at, as well as the fundamentals. If we start breaking 240, I'm going to reduce the position. Those of you who have been with us for a while, specifically prior to November 23, this has been your sequence of events. If you brought new money in or you're new to us, this isn't going to really apply. But we started in November 23 with a 1% allocation in CrowdStrike. I added another 1% on February 2nd right here at 294. So we're in at about 188.5, 294. It's been sideways. We moved up. I did add a 0.5% allocation to bring us up to 2.5% on the last rebalance on June 24th. So right now we're trading 276. So if you're with us prior to November of 2023, your average cost is 270, 260, trading 276. So believe it or not, like you're actually up, and that's the value of having a good entry price on a high momentum stock. If you get hit hard and you have a good entry, okay, well, we gave back a lot of profits on this 2.5% allocation, but we're watching. So again, if we start to break 240, I'm going to start to reduce the position, but we're watching that closely. Oh, I'll take a breath. Kyle, what did I leave out?
Just what's going to happen the rest of the year. Let's go ahead and get the crystal ball out and we'll tell everyone.
Nobody knows.
We need to tell everyone who's going to win or just be nominated in the election. That's what we can add.
Even if we knew who was going to win, I don't think we would have any edge as to where to be in the stock market. You have no idea how markets
probably not
react to it. Yeah.
Probably not, right.
But yeah, so we're watching the seasonality in the end of the year. We're watching the upside resistance levels, seasonality in the summer into September. We're watching the resistance levels. We know the tape bombs, as they call it. The tripwires out there. We're watching, but we like how the market's responding, and we're now really in the heart of earnings season with Google and Tesla tonight. So we'll see how that goes. Tesla, we've reduced our allocation. We have no allocation, no holding for the first time ever in Tesla. That could be a mistake. We'll see. It's been underperforming for quite some time. We'll see how earnings go tonight. And then the next 2 weeks, we're going to get heavy earnings. And then, I expect things to go quiet. It should calm down, hopefully, on the political front. We'll know who the candidates are. We'll be through earnings season. We'll be waiting for the first rate cut in September. It could go quiet. We'll see. In August into September, but we're not going to let things get out of control. So that's the market side. That's why the beauty of I think of this thing we've put together as a combination of active management, being on top of the markets, with rock solid financial planning. When both are taken care of, I think that's a beautiful combination. And I know Kyle's doing a hell of a job with everybody who's working with him on the planning side. So. If you have any questions, comments, anything, please let us know. Again, closing thoughts, I'll leave it to you, Kyle.
No, I think this was good, timely info. And I mean, if y'all have any questions or want to connect, just reach out to us on the website or if you have our email, drop us a line anytime.
Yeah. And if you guys need the intern to do anything, just send us an email. We'll get them right on it. Okay.
Yeah. Good, cheap labor.
He's going to be sick of our abuse at the end of this.
Yeah, we've already had someone rename him. So,
oh, yeah?
Remember Keith?
Yeah, right.
Yeah. So
do you want to talk about
we prefer intern. We just prefer intern.
Do you want to talk about what he's working on, or do you want to leave that as a surprise?
Yeah, for current clients, we're gonna have some new reporting, quarterly report that we've been working on that he's been making look nice, and we're gonna have all sorts of account information, It's going to come out quarterly, have pretty much everything you would want to see on the account, and then also a new client portal with some more information. So really increasing y'all's visibility into the accounts. Right now, you can see everything on Schwab. Their reporting is pretty good, and all the information's there. But this will just be packaged a little more nicely, so it'll be very readable, and we think it'll be a good addition.
Nice. Trevor, you want to come over and say hi? You might get an echo, Kyle. I'm going to take off the headset. Here's Trevor.
Where should I go?
Right there. Camera's in there.
This is live?
Oh, recording.
Okay.
Yeah.
Nice to meet you guys. I'm Trevor. I'm the intern. You already said sophomore BU. All right. I'm from 45 minutes away. Live over by Todd. So happy to work for you guys, with you guys. Nice to meet you guys.
Well done. Doing well. He's part of the BU Investment Club, and you have aspirations to go into investment banking,
Yeah.
right?
As of right now, we'll see.
We're trying
Plans
to
might change.
plans. I didn't know what I was
Yeah.
doing at 18 years old, so
I think everyone wants to.
Yeah.
Go BU when they're 19.
Yeah.
So we'll see.
that's good, man. That's
Yeah.
good. He's doing a great job. Hard worker, smart kid. So we're lucky to have him. All right.
Absolutely.
Anything else, Kyle? We left out?
No, I thought that was good. I'm wondering how we did on time, but we'll keep coming out with new videos.
Yeah, that's an hour 11. But I mean, and I know
Oh,
you're
whoops.
I know you're hearing a echo in your ear right now. Yeah, but I mean, we just got hit by, like I said, I mean, there's 4 pretty significant things, from Supreme Court ruling, monetary policy, political changes in the polls, and then market technicals on the short covering of small caps. There's a lot going on right now. So,
Yeah. Busy week.
yeah. All right. Well, hey, thanks. Good work. And clients, we'll talk to you soon. And if you have any questions, guys, hit us up at Inside Edge Capital. Emails there, websites there, and all the best. Best of luck in the markets.
Take care, everyone. See ya.